This is the current federal tax developments brought to you by the Loscalzo Institute and your state society of CPAs for the week of July 24th, 2017. I'm Ed Zollers, and we'll be discussing this week some various developments that have come up. First thing I should explain, I've been on the road, so if this sounds a little different, I'm using a different microphone this week. For various reasons, the other one is packed away at this instant. So I've got this one, so hopefully it doesn't sound too bad, but if you hear something sounds a little different, recording on a different setup this week. This week's developments. We'll talk briefly about where we stand with Congress because we now have two reconciliation bills that Congress is working on currently. We'll talk about where we stand on both the first one, which was to be the vehicle to deal with comprehensive tax reform, or I should say to deal with the healthcare issue. And then we'll talk about the second reconciliation bill, which is getting started, which is meant to be the vehicle to bring forward comprehensive tax reform. We'll also talk about a tax case that gives a lesson to the taxpayer on the claim of right doctrine and the doctrine of rescission. We'll talk about the IRS's extension for the third time of the safe harbor reporting for HFA borrowers. We'll discover a taxpayer who couldn't prove that he told his broker to use a method other than FIFO for cost assumption for securities that were sold. And finally, we'll close out this week with a discussion of what exactly is the effect of those executive orders that were issued early this year that were meant to require agencies to provide ACA relief. Do they actually get rid of the penalties under the ACA? We'll take a look at 3 information letters issued by the IRS that discuss this topic. Well, a few things are coming up this week, and basically I'm heading out this week, going to be in Bozeman, Montana on Thursday for a course on income taxation of trusts and estates. So if you're going to be there, you can go ahead. You can still sign up if you're listening early in the week to be in Bozeman. On the 3rd and the 4th, I'm scheduled to be in Albuquerque, New Mexico on August the 3rd, discussing accounting methods. We'll also discuss somewhat in that course the issue of the impact of the changes under ASC 606 that FASB is putting in and how that may trigger a need to have an accounting method change for tax purposes. And hopefully you've been thinking of that. You've been doing this ASC 606 work with revenue recognition for your clients who issue GAAP financial statements. And we'll also talk about financial planning strategies on August 4th. This is a kind of course that looks over all kinds of issues that your clients always expect you to know, like issues regarding how Social Security works, issues regarding estate planning, issues regarding paying for college education, all of those issues on August the 4th. Coming up on August the 9th, we have basically coming up this week a set of courses that are going to be coming up in Arizona the following week. We're going to talk about fringe benefits, and I will talk about Arizona's earned paid sick time. We'll also talk about preparing Form 1041. That's another, the second day of courses. And finally, on the 10th, I'll be talking about a full 8-hour course on ethics and quality control and tax practice. These will be at the Arizona Society of CPAs office in Phoenix. You can sign up at ascpa.org if you want to attend those courses. I also want to highlight a course being taught by another instructor for us here at Loscalzo Institute, Stacy Painter. We'll be doing 2 days of various, this is kind of a mix and match set of courses in Anchorage, Alaska. On August the 17th, start out with a 4-hour session on analytical procedures workshop from 8:30 a.m. to noon. We'll be doing then 2 2-hour sessions in the afternoon, analyzing financial statements, a guide from 12:30 p.m. to 2:15, and efficiency and effectiveness in documentation review at 2:30 to 4:15 p.m. there on August the 17th. On August the 18th, Stacy will be presenting 4 hours in the morning on deceptive accounting practices. In the afternoon, we'll have a 2-hour course on the statement of cash flows, and we'll close out the day with related party transactions, a recurring issue. If you're going to be in the Anchorage area, you can sign up for those courses at www.acacpa.org for the Alaska Society of CPAs. And, if you haven't been to Anchorage, actually, I was there a couple of years ago. It's a very, very interesting, nice location to go to. Just, you get a little confused by basically sunrise, sunset, a little confusing. Those of you there are used to, having days going super long to super short. But it's a really nice place, especially in the summertime. Should be a wonderful place to be. So you might want to take a look at looking for those courses there in the Alaska area. Okay, let's move on now to our issue of what's coming up this week. And we know we spent most of this year, we're waiting on two big congressional moves that have been promised that were both going to have tax impact. Well, the one that's gotten the most coverage in the general press so far, and the one that we'll talk about briefly, is the move on the healthcare front. At this point in time, on here, the beginning of the week, again, this stuff changes, so by the end of Monday, it could very well be different. But as things were going currently, the Senate plans to attempt to start the debate on the health care bill this week with a vote to open debate. May or may not have the votes to actually get the debate started. But the Senate apparently is going to try for that, have that vote, see where the votes lie. If we do start debate, then we'll look and see whether or not any bill actually comes out. If it does, we'll discuss what they've given us, and we'll give a more full discussion once we would have a bill passed by both the Senate and House. I think you may need to keep your eye on this. I would certainly not say the process is dead, though I'd certainly also not say it's clear we're going to get a bill. What's true right now is things change quickly, so you want to be very, very much aware of what's going on here. And again, if anything happens, we'll talk to you about that here. Now, that was a reconciliation bill for the year ended September 30, 2017. The House is now working on the next year's reconciliation bill, which, according to the game plan, is supposed to be the vehicle by which the Congress will move comprehensive tax reform. The House Budget Committee this week approved the budget resolution that would be allowed to start that process. A full House vote is scheduled for later this week on this process, this reconciliation bill. So we'll see if the process gets moving. That'll start us down discussions as to what Congress is doing with regard to comprehensive tax reform. One major thing that almost stopped a very important part of what at least the House Ways and Means Chair and the Speaker of the House believed were a key component of this tax reform, almost got risk of being stopped in its tracks. There was turned away an attempted amendment by Representative Mark Sanford of South Carolina. Now, Mr. Sanford, now I realize there are Democrats that offer amendments. We don't really care about those in the House. But Representative Sanford is a Republican. He offered a bill that would have changed the rules and stated, given orders for reconciliation, that they were not to count any revenue raised by a border adjustable tax in their scoring of the bill. Well, if you did that, that pretty much wipes out the reason for having it, since border adjustable raised the revenue that would allow other things to happen. So that would have had the practical impact, to be totally honest, of probably killing the border adjustable tax. They did succeed in turning that away at this point, actually succeeded in ensuring they didn't vote on it in committee, because assuming Mr. Sanford would vote for his own amendment, we would have to have assumed the Democrats on the committee would have voted for it as well, and that could have very well killed it before we get started. Keep a close eye, because this sort of amendment or this sort of process, we'll see how quickly. There is definitely a lot of strong opposition to border adjustable tax in the House, and that opposition is not confined to Democrats. So we may have to keep an eye on where that happens. If that happens, it radically changes the types of reforms Congress can bring forward, simply because it takes a ton of revenue off the table. So we'll keep your eye on that particular program. Now let's go on to our first regular development of the week. This is the case of Yaklik versus Commissioner, Tax Court Memorandum Decision 2017-143. This was issued on July 19th of 2017. This deals with a taxpayer who applied for and was paid $3,360 in unemployment from the state of Arizona in 2012. Now, at some point, there was a question as to whether he was eligible for it. The employer may very well have filed an appeal, may have filed a statement. In any event, the state determined that Mr. Yaklik was not eligible to receive the unemployment benefits, and they indicated that he had to repay his benefits. His rights to appeal their decision expired essentially at November 26, 2012. Mr. Yaklik did not file for a hearing to appeal his rights. So the fact was he was going to have to repay these funds. So now comes time to do his 2012 income tax return. The state of Arizona, through Department of Economic Security, issued him a Form 1099 with that unemployment benefit of $33.60 on it. Mr. Yaklik, who during the following year actually repaid that $33.60, decided that since it had to be repaid, he didn't have to declare his income, and he didn't. Well, of course, the IRS, by the time we got this finished, happened to notice that it wasn't on his tax return. The question becomes, does Mr. Yaklik have to report this amount? I mean, he received it in 2012, but by the end of 2012, he was under orders to stop, basically kick it back over, give it back to the state of Arizona. And he actually did it in 2013. Well, the problem we run into is a basic concept under the tax law called the claim of right doctrine. The claim of right doctrine is actually a court-developed doctrine, which essentially means that if a taxpayer acquires his paid funds to which he has unrestricted use, but which the taxpayer later repays in a later year, because there may have been some contingencies or other issues that cause it to be repaid in a later year, the taxpayer still has to report that income in the year of receipt, assuming it has not been repaid by the end of the year of receipt. Now, Mr. Yaklik said, but wait. We already had the state of Arizona. My rights had been gone. There was no question I had to repay it. Doesn't this qualify for an exception to these rules? And the answer to that question was, well, there is a possible option. There is a doctrine of rescission. Now, rescission means legally the action never took place. So it's an exception. However, for tax purposes, you can get ahead without having to worry about the claim of right issue, even if you make the repayment in the following year. But you have to meet two requirements. And this comes, the court mentions this from the Blagledge case. And it talks about these two rules. Number one, the taxpayer recognize an existing and fixed obligation to repay the amount received and before the end of the year makes provision for repayment. So even though it's not actually repaid, the provision for repayment had been made. The court found that the problem for this particular taxpayer was he essentially never provided a rule that he never showed that he had made a provision for repayment prior to the end of 2012. Having failed to do so, he had to pick that up as income in 2012. Now, before you start wondering, because it seems like, well, this is inherently unfair, he's going to pay the money back, but he ends up having to pick it up in income. Under the claim of right doctrine, there is relief found in the code if the amount under section 1371 of the code, if the amount you receive is in excess of $3,000, you have two options. If it's less than $3,000, you've got a single option. The general rule is Mr. Yaklik can claim a deduction in the year of repayment for that $33.60. That is a miscellaneous itemized deduction not subject to the 2% limitation. So he can just take it on Schedule A. But if it's in excess of $3,000, in lieu of that, he can claim a credit equal to the amount his tax increased in 2012 due to having to include the $33.60. So you do a with and without calculation of his federal tax, you determine the credit, and then you claim that credit on the 2013 return, which was for him the year in which he repaid it. Now, the case doesn't tell us whether he actually did this. We don't know if he did or not. But that is the relief provision. So if you're not aware of this rule, it does not mean, this also applies where we see claim of right come up a lot is a client gets a new job, gets paid a signing bonus, but if they don't stay for like 3 years, they've got to repay some or all of that signing bonus. That's also a claim of right situation. In a claim of right situation, the same rules apply there. You have to pick it up as income initially. Next, we move on to IRS Notice 2017-40. In this case, the IRS has extended the safe harbor treatment for those who are receiving benefits from the hardest hit fund for the third time, this time extending the relief through 2021. The IRS had initially, when the hardest hit fund first came out, which was meant to provide relief to homeowners who are having trouble paying their mortgages. This is a state, in essence, you get state aid to pay the mortgage by this issue. So the IRS issued Notice 2011-14 that said that a homeowner can deduct on his or her federal income tax return the lesser of the sums of all the payments the homeowner actually made to the mortgage servicer or the state HFA, or the sum of the amounts shown on Form 1098 for mortgage interest received, real property taxes, and mortgage insurance premiums. If that latter part is deductible, you get those. In essence, you get the lesser of those two. That's how we can determine how much of the deductible expense you paid. The IRS had initially made that relief done for a short period. For 1 year, they extended it longer a second time. It was to have expired here this year. Now the IRS is saying we're going to extend this treatment all the way through 2021. They also extended the relief for mortgages, for mortgage servicers. They have an issue where they can just report a standard 1098 as long as they notify the homeowner that these are overstated because of state relief that was received, and give them notice about how they should handle this situation. This third extension through 2021, we'll see if we get another one. At some point, most of these loans will have been paid off, because the property will have been sold. The homeowner finally just flat out defaulted, whatever. But now we're going to have a full 10 years worth of coverage on these loans. We'll see if we get coverage beyond that point as we move forward. Next up, we have a case of a taxpayer trying to sell some stock. Turin versus Commissioner, Tax Court Memorandum Decision 2017-141, issued here on July 17th. Mr. Turin had an account with Scottrade. Now, normally he did short-term trades. So he'd buy stock, he'd hold it for a short period of time, and then he would sell it. He had a diversified portfolio, but he did hold some Fannie Mae stock where he had acquired it at multiple times, and he held this for a longer period of time. Now, the question becomes, how do we calculate his gain or loss on sale? Well, in the year in question, he had an account with Scottrade. He sold securities, but he apparently didn't remember to report any of them on his Form 1040 for that year. Well, IRS caught this little detail. And by the time we get to court, he had agreed that, yeah, he really did have all those sales. He should report that income. He agreed with the 1099-B basis shown by Scottrade and reported to the IRS, except for the basis reported on the Fannie Mae stock. He said he claimed that it really should be LIFO. Now, one of the hitches you've got is essentially under Regulation 1.1012-1C1. If a taxpayer has stock on account with a broker, the stock the taxpayer is deemed to sell, stock or other securities, is deemed to sell is the oldest, longest held security if we've acquired these securities at multiple times, unless the taxpayer gives notification under the rules found at Regulation 1.1012-1C2 and 3. Prior to sale, notifies the broker of the specific shares that they want to be treated as deemed sold. Now, as we know, the broker is not really going to go find your share, but we're going to pretend they did if you gave that notice. And that notice needs to be given to the broker before the sale took place. In the old days, before everything went online, we used to have the notes would be on the actual confirmation slips that we received. Well, here the problem was he claimed he tried to go online and tell Scottrade prior to the sale that he wanted to use the LIFO basis, but that their website had failed him in some way, shape, or form. So he claimed after that he tried to call Scottrade and tried to fix the problem with Scottrade over the phone. Now, the one unfortunate thing that he had with that was that Scottrade had no record of either a web attempt on the account to do something or send a message, or a phone call from him regarding his account on any topic, not just this one. So unfortunately, the court found, since the burden of proof is on the taxpayer, to prove that the taxpayer, gave that notice to the brokerage firm, that Mr. Turin had to report the sale of the Fannie Mae stock using the FIFO method, not LIFO. Now, of course, he probably wanted LIFO because the stock price had been increasing, and that would have reduced his gain. It's important to remember that taxpayers must now, they're now required to use FIFO method. Well, they've always been. But now the problem is with basis being reported on 1099-Bs, and we're much further out. The reality is that the IRS now has a lot better methods of enforcing these rules than they previously did. You have to be able to show notification to the broker. Does that mean the broker's basis is always right? No, but it does mean that you're probably better have documentation to back up why you have a different basis number. And if you're asking for a different cost flow assumption, you've got to have evidence that the notice was provided to the broker, have some evidence other than merely, which Mr. Turin had, just your word. What he really should have done, let's assume he did make the call, that would have been the point of recorded date, time of call, and who you talked with the Scottrade, what the resolution was, basically get the whole background. The problem in his case was he just claimed to have done something, and he couldn't produce any evidence that, in fact, this call ever took place. And in fact, Scottrade said they had no record of any calls ever on his account. Bad news for Mr. Turin. Next up, something that was big early this year and caused a lot of discussion when it came down. This looks at the issue regarding the executive orders issued by President Trump on January 20th, shortly after he was inaugurated, regarding the Affordable Care Act. Those executive orders, the executive order in this case, ordered agencies to exercise authority and discretion permitted to them by law to reduce the burdens of the Affordable Care Act, pending the repeal of that act by Congress. On January 20th, the idea had been, or at least the idea communicated after Republican leadership of Congress had met, was that they planned to have this whole ACA repeal issue tied down and taken care of by early April at the latest. So at the time this was issued, a lot of people read this as saying, well, we have an ACA bill that is going to repeal the penalties. Congress will repeal those retroactive for last year. So what this really means is you can go ahead, file your return, don't pay the penalties, and the penalties never will happen. And you don't need to file it with a penalty today and then have to go back later and file a claim for refund. So there were basically many ideas that was how it would happen. And a lot of clients, and certainly clients and the press, read it that way. Well, the best laid plans of mice and men go awry, and repeal, as we're all aware, has gotten stuck in Congress. We are sitting here now in July, and we're heading toward the August recess, and Congress is currently definitely mired down. We have had a repeal and replace bill pass the House, but as of the instant we're recording this podcast, we have real issues in the Senate. In fact, even though we know they're opening discussion next week, or they're going to try to, if they do succeed in opening discussion, it's not clear whether they're going to be moving on the bill that, was the bill that was offered to us initially, or whether they're going to go straight to an attempt to amend that bill instantly to a pure repeal and then try to have that vote, or whether, in fact, the whole concept of getting to opening up the floor for debate on this happens at all is open. So in any event, as of today, it appears very possible that Congress will go to the August recess with no repeal and replace bill passed, and with nothing on the horizon to get it passed. So the question becomes, what about those 2016 returns for taxpayers who filed the return, did not have coverage for all months of the year? Do they owe those penalties? And what about large employers who did not provide affordable minimum essential coverage that offered minimum value to all employees last year, and at least somebody went to the exchange. Do they owe penalties? Well, the IRS issued 3 information letters this week. Information letters 2017-10, 13, and 17. Those 3 letters, 2 of those letters deal with the penalties for large entities, for ALE, applicable large employers. One of them deals with individuals. Congress, basically, the IRS said, look, the executive order did not change the law. Nothing in the law allows for an applicable large employer who owes the shared responsibility penalty to get out of that penalty, and we were not given as an agency the discretion to allow people to get out of that penalty. Now, I would say in the back of my mind, some of you may remember that the first year this penalty was supposed to apply, the IRS didn't apply it. So, some may be wondering about that interpretation, but nevertheless, literally per the law, that's right. Now, were they wrong back 2 years ago? Well, very possibly, yes, but are you going to go volunteer to throw the money in? Okay, so that's kind of the odd situation. So the IRS says they owe the penalty, which is basically means you should expect to get a bill from the exchange for the penalty for 2016 unless Congress changes the law. They also said that generally for individuals, unless you meet one of the exceptions, and there are some exceptions that can get you out if the cost would have been above the percentage for the year that you have to give out of pocket, that you're exempted from the penalty. But if you don't meet that exemption or one of the other exemptions, you also owe the penalty. And again, there was no additional option, the service believes, for them to just give blanket relief. So based on that, one issue we've got right now, there's a practical issue for those of us who prepare these returns, is right now it appears that there may not be any sort of authority that allows us to sign a return where we do not at least report those penalties. Now where the taxpayer decides to send along the check to pay them, that's a whole nother question. But it does suggest, now I realize the IRS would accept returns that don't answer the question, but that doesn't mean, the mere fact they accept a return doesn't mean that it's a correct return or it's a return that you can sign. So that's the other problem we run into. So it puts us as preparers in a very odd position with regard to these rules. And again, if we do not see, Congress could obviously solve this problem entirely by passing a bill that retroactively removes the 16 penalties. But until that time, we just kind of have problems working with this going forward. And you're going to have real problems explaining this to your clients who believe they remember hearing back in January that they didn't know the penalties for 16. And it turns out, well, that wasn't quite what you heard. Well, still continuing, please remember, check out the CPE your state societies have. This broadcast comes to you because of the support we receive from the state societies of CPAs for putting on the live courses. So I want you to be sure, take a look at what they offer. It gives you a chance to have a full day, discuss various issues with an expert in the field. So take a look at your state society's offerings and, sign up, and we'll see you out there at some time. This has been the current federal tax developments for the week of July 24th, 2017. You can catch our daily, or however often, not really daily, but we post whatever time, we see something come up during the week that we think is important on our website at currentfederaltaxdevelopments.com. You can also download a PDF with all of today's articles on the website at currentfederaltaxdevelopments.com. Just follow the weekly update links and find this particular broadcast. You can also send any questions or comments to me at edzollers@currentfederaltaxdevelopments.com. If you have any questions about tax matters, questions about what we've talked about on these broadcasts, let me know. You can also follow me on Twitter at edzollers. Whenever we post something on currentfederaltaxdevelopments.com, I will generally post a notice to Twitter so you know it's there as well. Well, we're going to check out for another week. I'm off to Montana. When I get back from Montana, I'll be recording next weekend, probably again, for those of you who pick it up as soon as possible, you go find it on the website when I post it. Just like this week, I have a feeling we'll be posting on Sunday. But we'll go ahead and we'll take a look and, we'll try to get everything done. Be sure to be back with me. For those of you that actually follow the weekday stuff, we'll see you next Monday here on Current Federal Tax Developments.